Good evening. Hi. Uh, this is, well, my son showing you that this is his cars, so he can buy them and so on. So, okay, just doing some random market answers here where it's this Saturday and it's 9 p.m. and you know, there has been no alcohol consumed before this meeting has gone. So first a disclaimer, no advice, no don't take this as advice or recommendations. I'm not going to talk about individual stocks per se as a recommendation or something, but just that. There's the first question was by Chandrasekhar about how does the USD INR look to you from a fundamental perspective. I think my answer is, it looks weak. It's probably going to get weaker towards the end of the year. In case you wondered, that's the underbodies of cars that's going to sit between us for a while now. But from a fundamental perspective, the USD INR are actually quite weak. If you look at what's happening with other currencies, especially Brazilian yen, Brazilian lira. I don't know what even this their the BRL, Brazilian lira, I think, and the Russian ruble, which was beyond 85 for a while. This is going to be hyper competitive for us, at least in the export space. We are actually, to be honest, if you remove gold, we are actually not a net importer. So gold literally tips the balance. If the government gold schemes are successful, we might not need quite as much in terms of imports anymore. However, remember that if the rupee is strong in relative to many of its currencies, many of the relative currencies in Asia or in the BRICS emerging markets, I think the USD INR will be quite weak for the rupee, strong for the USD. USD is going to be strong against most other currencies this year because the US is the only strong economy apparently in the developed market space. So I believe 70 will be a pit stop if things go bad. There was another question later or earlier from here which talked about how USD INR will behave later this year. We've got a detailed note on this, but basically what's happened in 2013 was after Subba Rao and Rajan came in, there was a big crisis at that time. The rupee was at 68. At that time, Rajan brought in this measure, if you may, for attracting NRI deposits that attracted $32 billion. It's time to return that money now. Later this year, $32 billion will have to be returned to NRIs. RBI has done some hedging. The unfortunate problem is it's done its hedging with other participants who have to somehow give it dollars and take rupees. So this hedging will not necessarily work very easily because 32 billion is a lot of money. So later this year, after September, we're going to see some very interesting issues about the real estate, about the USD INR space. A couple of other questions. What's the pros and cons of ETFs with respect to mutual funds? ETFs are, ETFs in India are less efficient. Sometimes their ratios, their tracking errors are very high. We've seen that in some BSE Sensex ETFs. Some of them have very low AUM, so they can't really track the index because you need a certain AUM just to track it. Some of them have high fees, so that's why the tracking errors increase over time, like gold ETFs, which has a 1% cost per year. So after 5 years, there will be a 5% difference between its price and the price of gold. So that's one problem with it. There's also the fact that most indexes seem to underperform most active mutual funds. So I believe ETFs are not quite as attractive in India. Plus you have the liquidity problem. I think it's very useful for you to buy an ETF to participate in the US markets if there was one that took your money and then put it in an index abroad, because that's where ETFs may shine out, because you don't get easily mutual funds that do this on a regular basis. But yeah, having said that, there's probably little demand for ETFs in any case. they have more documentary requirements than mutual funds. Some of the other things that we've seen is, okay, we've got that. How does one decide when to sell? Actually, I don't know. I think the two or three broad points is: one, when you need money, and you've pretty much exhausted your emergency buffers and you want to get money from somewhere for something. Second one is, where did you decide where to sell based on your high investment hypothesis? So if it was technical, it was a target or a stop loss. If it was fundamental, it was something about the business that you don't like anymore, and much of that corresponds to changing events, changing data. Would you still be an investor in Vedanta after it's fallen, I don't know, 70%? Would you be an investor in DLF if you're bought at 1,000 and it's at 100 today? At some point in the middle, you would have given up on this whole charade, and you'd say, okay, let's move money out. Typically, I would say find the amount of losses that you can take, 30%, 40%, and then don't take any losses after that. It doesn't matter. So that's my personal belief. Yours, again, not investment advice. What's more important, fundamental or technical levels for stocks? What can be the positive trigger? Okay, two questions here. I guess what's important, fundamental or technical? It depends on who you are as an investor. If you're not comfortable with technicals, then fundamentals is probably important for you. Technical levels are useful, according to me at least, for people to not get carried away by news that is largely reported earnings or reported numbers, because what is reported sometimes is not true, and there is almost no way you can find out that's not true. So technicals typically give you a signal that's different from fundamentals, and sometimes earlier as well. Most of the time the technical experts would tell you there is a trigger that comes in technically before the fundamentals show something. Sometimes people know fundamentally that something is wrong earlier. In Enron's case, in the US, I think both views applied quite solidly. You got technical signals and fundamental signals. So that was that. More questions. Is there any tool to any tool for a common investor to understand whether the market is undervalued or overvalued? A lot of interesting measures of valuation, but at a market level, I think you'd get better instruments than at a instrument or a stock level, because I could tell you PE, and PE makes sense for a market sometimes, but sometimes it doesn't. I mean, it's just a matter of figuring out where forward earnings come from and whether estimates are likely to be correct. In most cases, they're not. Forward earnings for a individual stock may be completely wrong. In fact, that is where you have to have a lot of subjectivity. Largely, I believe that the concept of overvalued or undervalued is something that it's very specific to the kind of investor you are. A technical investor may actually be trading breakouts, at which time overpriced securities to the fundamental investor actually looks like it's a great underpriced security for the technical investor. So that's the difference between the two. There's a bad answer, I know. I would wish I could tell you, okay, buy at PE less than 15, but that doesn't make any sense all the time. Many stocks don't trade particularly close to the P's that they should, so you have to know where it's going. The global question is it time to buy? I don't know. I don't think so. I think one day of positivity has not really changed all those days of negativity that we've seen so far in terms of FIs. And FIs did sell in the cash market. That's pizza, by the way, so I'm going to just go get it. So one sec. Okay, it's being got. That's good. So interestingly, the concept of what's happening with the markets today is that we're seeing FIs sell. We've got this at Upticker, Vashisht, who actually says there is a suckers index, and we'll come to that at some point, and that index seemed to have turned. So it's a complicated thing that's mentioned in you know, in the FI data and the retail and client participant data. So apparently that has turned. So hopefully, yes, retail investors seem to have started to go short, which means it's usually time to start going long. So that's a signal that we've seen after like nearly a month and a half now. So that may be a turning point. Rating agencies, since they can't be held accountable, do we have other tools? Answer, you have to look at each instrument by its own. It's very difficult because rating agencies have access to more information, and what would actually be useful is to look at market prices, market financial accounts, if you're able to understand those better. If you're going to rely on the rating, please do note that rating agencies have no responsibility if their rating is wrong, or if they were supposed to have identified something and did not. That means nothing. You can't sue them, you can't do anything. It's just an opinion. That's exactly like what I'm saying right now, because I'm just saying stuff and nobody can sue me for my opinion on what I just said. How should a common investor judge the economic situation, given that data is often interpreted in favor of the incumbent government? I don't know. It's basically stop listening. So if you look at some of the popular TV channels that do the news thing, not the business news, but the regular news thing, typically what they tell you is the opposite. This thing. So yeah, Android trader. I am taking questions, but I've got questions on the list over here. So I'm looking at the questions here as well. So it's a little difficult to do both. Tweet to @Deepak Shenoy if you want me to answer questions. I think I'm getting a bunch over here. I can't. It seems to be passing through too fast. So if you can tweet them here, there's nothing like it. Okay, so cool, good. Okay, so broadcast not found. Okay, that was something very strange. Can't tweet and watch at the same time. Android trader. Hey, by the way, I got your question on Singapore and on Kaveri Seeds. They're a agriculture something company, so I think they don't pay tax because of that. This agriculture thing doesn't have to pay tax, so apparently that's not a problem. There is some other stuff that is a problem, but definitely not the tax issue. There is, okay. So have I answered all the questions yet? How should a common investor judge the economic situation? You know what, you've actually got to do the opposite of what people are supposed to react. If government tells you there's a 7.5% growth rate, but if you look at the data and it tells you there's a there is a 6% nominal growth, nominal being in real rupee terms, in rupee terms, compared to once you back off inflation. They're just saying that inflation is negative right now. So that's how complex this situation is. You're growing at 7.5%, but you're really growing at 6%, and there's negative inflation, so you're growing at 7.5. That doesn't make any sense to me. In the longer term, this is going to hurt us. So you have to actually go down there. Why so much hype about Reliance Jio? I think it's basically because you've got them changing the entire market the last time. They brought in 500 rupee phones and connections. They did that Air Deccan of telecom, right? So they literally changed the entire game. The only thing that matters now is from a geo perspective, is are they going to come in and offer actual 3G 4G level speeds? Because right now we're getting like 1G, okay, for the most part, and I'm on my own network, and I'm hoping that this thing doesn't break at some point. But obviously it's not the best kind of connection that you'd want. Okay, we're done with questions. Okay, you can ask me more. Index mutual Nifty piece has a positive tracking error, Prashant, because its fees are 0.8%, 7% in total, and Nifty's dividends are 2%. So because the index doesn't adjust for dividends, you get this positive 1% tracking error every year. So as long as they don't pay out a dividend, your tracking error remains in that system. So sometimes I think they just kind of retain it for a while, so they don't pay out the dividend every single year. How do you expect CPI to go over this calendar year? I think, okay, CPI is going to probably remain benign, not for anything else, but because, if oil prices remain like this, we're not going to, see much over here. Um, yeah, I don't expect it to go above 6%. Resurgence of metal stocks. Are metal prices have to change? No, we are at bloody 15-year lows on everything. So unless metal prices change, these metal stocks are not going to change. In fact, the best thing that would happen for them is a few bankruptcies in this area, in India at least. What is very bad in this area would be, those duties, import duties. If they increase import duties, you can say goodbye to most of these stocks, because that doesn't help. They are in deep trouble. They don't have, I mean, come on, we should be using these low prices to build our infrastructure, and not, protect our metal players. Come on, we deserve better than this. And, okay, forget that. That's a different argument. But essentially, this is the situation. um, can the looming shale oil bankruptcy affect markets? I'll come to tire stocks after this. Um, the looming bankruptcy of shale oil in developed markets like the US is actually negative for oil. uh, because what happens is, let me give you this example. Okay, I quote this a lot, but take you're an you're, let's say, a bank who's financed, or a bond holder of me, which is a shale oil person. I have taken $500 million from you. I have gone and fracked, and I have, cut open the earth and found oil. For me now, I've spent a large amount of the fixed cost, right? So the next point is for me to extract this oil. I can't sell because oil is at $25-30. It's too much for me. I can't pay back the 500 million. I go bankrupt. What happens? You, as a bondholder, say you give me 500 million. Somebody else comes, and this is what happens in America all the time. Okay, somebody else comes and says, you got $500 million. I'll give you 350. Will you take it? For you, the choice is 350 or zero. It's a simple choice. You take it. You say, okay, I'll lose 150 here. I might make it on something else. I'm going to move on. This happens in developed markets. It happens in America a lot. So now the next person gets that shale oil, which I dug for $500 million. I spent money to go in, and I spent most of it. He's getting that for 350. He goes bankrupt. 2 rounds. Now the fixed cost is down to 200 million. Somebody's lost 300 million along the way. That's fine, because these people are willing to take losses. That's how risk worked in the first place. Some people who lent will also go bankrupt. That's fine. That's fine again. Unlike India, where bankruptcies take 10 years, these things happen in 6 months, 8 months. 8 months later, you got a guy who's saying, listen, my fixed cost is done. It's $100 million. Now it costs me $12 to get the oil out. I can take it out on demand. So if the oil price went up, I could do that well and use different chemicals to recover more oil, or I could recover a little bit less if I use a little bit less money. So the variable cost of oil is much lower than the 26, 28, $30 that we're talking about right now. So I expect that oil bankruptcies are going to hurt countries like Saudi Arabia, who think, if they think that the oil bankruptcies is going to change the game. It's going to hurt them more than it hurts anybody else. But that's not the Saudi take on this. I'm sure of that. They're not doing this to bankrupt shale oil producers. That's just a convenient story that the media has cooked up. What's your take on gold? Oh man, there's nothing in gold, man. If India's schemes succeed, I believe gold will just remain here. I think Chinese demand can change the equation, but at this point, Chinese demand for anything, and China is probably going to lock down a little bit of its capital. They're not going to allow capital to flow out of the country easily. They're facing a massive yuan devaluation. They're not driving it, they're facing it. They're trying to protect the yuan from falling, similar to what the RBI is doing, which is trying to protect the rupee right now at 68. So gold, I think, is not going to go up in a hurry. However, because of the rupee depreciation, you might see some increased prices in rupees. But I did give the INR view a little bit earlier. Cool. Okay, so I think that's pretty much the end of questions. I'm not sure if there are any more. Have I missed anything? Sometimes Twitter gives me these little numbers. Same effect as gold. The company selling cars. Oh, we've got tires and cars. Yes. Um, so uh, tires first. What's happening with tires is that Chinese companies are able to sell tires at 60, 50, 60% discounts apparently. uh, I need to change my tires in my car at some point, so I'm going to find out. And I will buy a Chinese tire at if it's a 50% lower. There is no point paying 50%. Why should I spend more from my money, from my pocket, just because it's an Indian tire? I'm not going to. So if you're going to give me stuff that's 50% cheaper and it's rubber, vulcanized rubber, come on. I mean, how complicated is that? But yeah, I'm not going to talk individual stocks here right now. Just too late in the night and it's Saturday and all that. But yeah, I mean, tire companies are going to face a challenge. They're going to have to cut prices. We have a big problem in that the government has reduced rubber imports because rubber was really, really cheap outside. I think rubber is going to, is going to fall worldwide or going to, stay under control worldwide. If Indian prices go up, our tire companies can't compete in any case, and we're going to have duty on imports. Duty on rubber, duty on tire imports. How much duty will you put? Yeah, I mean, in the end, it's just nonsense. But yeah, so any book recommendations? We don't. I don't. I think online material is very, very good. There's not so much, but there's a book that is called "What Goes Up." I forget who the author is, but it's a brilliant book about how the U.S. stock market evolved through the 1929 bust, and then further on how mutual funds came along, how KKR was formed, and how the US brokerages who were earlier always 1/8 of a dollar was charged as brokerage per share. At some point, this was a rule in the US, and sometime they freed up the brokerages, and that's when discount brokerages came around. Vanguard happened. So it's a great book. You should read it, and it's entirely a bunch of quotes by people who pertain to a certain situation. So it's not the author's opinion on it. It's just real actual quotes by people, including the founders of KKR. So it's a great book. I think one should read that. The name of the book is What Goes Up. I wish there was a way to type it in, but what goes up, it's going to be too complicated to do the typing here. I'm still going to ruffle my hair because I barely have any, so I just want to make sure that I don't look entirely bald in presentation. My wife's giving me a look, so so yeah. What was the other questions? If you guys have questions, could you type them again? I'm sorry, I've missed a lot. Textile companies, yes, I've got an answer about textile companies. I'm sorry, I move a lot because this is in my hand. I should probably stop keeping it in my hand, or just stay quiet. So textile companies are bound to benefit. Now there is some problem in China. The Chinese companies used to get a lot of yarn from us and cotton. Apparently they had stopped a lot of orders, so companies that make yarn, including some that were mentioned, are probably going to suffer a little bit. But there are companies that won't. There are companies that export not to China but to other markets. There are also companies that go into different geographies and do very high-end yarn, so those may not be impacted as much. However, remember this, there is a reason why the world is in a recession. They're not buying stuff, so you're not going to see the same volume game. You're going to have to deal with players who work with efficiencies. People who are doing a large amount of capex right now are going to be disappointed. You just want people to continue high utilization, and just the dollar rupee equation will drive them higher. Yes, huge rollover costs of buying oil futures in India. I think the contango is always bad, right? I'm not sure about whether it's only in India, but US markets are of course much better. My view on chemical companies, I think they should benefit. We've seen a very, very interesting run in the IIP data for chemical manufacturing. So they had gone up. So we've seen everything. I mean, we've, even some of the new companies, I think Alchem or one of these guys are not Alchem. Alchem is more pharma-ish, but there are a number of companies that do inorganic, organic, base chemicals, extracts, solvents. These are definitely pepping up in terms of manufacturing. A lot of the raw material prices have come down, especially when you're talking about organic stuff, because eventually that organic thing might have a crude input, and then boom, you got crude at $20 or $30. My view of GST, I give up, man. I want it to happen, but there is there's no point in doing any more justification of GST. You need it, but not going to happen. It's until this political quagmire has gone. I wanted GST for a long time, but it's just not happening. Lastly, I think there was another question, I forget. So I think we've talked about GST, we talked about so what else is happening? The budget, yes. Um, what I think the government should give up its 3.9% target. You're not going to make it. It's 3.9% of a lesser number. That's the good thing. But a good amount of it is going to be interest that is paid on existing bonds. We have fairly large, 40 lakh, 45 lakh crores of government borrowing that has to be paid. So we pay more than 3 lakh crores a year as interest. If they were able to keep inflation low, and that will only happen if they reduce fuel prices. If they keep inflation low, interest rates will fall over time. Your interest burden will come down. You need it to come down. You need interest rates at 4%. You want small savings rates at 4%. People with PPF, you are not going to get 8% for the rest of your lives. Please assume that is not going to happen. We can fight it tooth and nail, but we would be stupid, because in order to grow, we're going to have to reduce interest rates. At 8% compared to most other countries, your cost of capital for building a business is extremely high. There's a good reason, and 70% of the banking system is PSU banks. You got to change that part of the equation as well. They're not efficient. They're going to most likely a lot of consolidation is going to happen, and they're going to have to throw open some of those gates to the public. We got to make sure they are less than 10% of the banking system in the next 10 years, because we get new banks, not because these banks are sold. We don't care about those banks. Let them keep their deposit base at exactly where they are. Let's just build new banks that are better. I think that's the way we should see the new banking system, and that's the way the RBI should be seeing the banking system. Let 1,000 banks bloom, but I am nobody. Okay, so my view about finance minister change, I think finance minister changing is, I think, it's a tough topic to ask, because who's going to replace him? If it's going to be a guy like Piyush Goyal, or if it's going to be one of these other guys who have done really well in their departments, I think that will be quite interesting. But the finance ministry by itself is a very complicated role, so it's not easy to do things. I don't think it's one minister that runs everything. I believe that no, I'm not going to apply. Oh, God, finance minister, come on, it just ends pretty much everything, right? So you better be rich before you become a finance minister. But after that, you're not going to get a job anywhere. As in, you don't want a job, but you can't technically have your integrity and work unless you're a lawyer. And I'm not. So forget that. That's just not going to happen. So, yeah, I mean, much of the rest is finance minister change might be interesting. It always is, but let's see where it goes. How does reducing oil prices help? There's a need to reduce a deficit. You could reduce it by selling assets. You have 60,000 crores of Axis Bank and L&T shares. Bloody get rid of them, man. There are hundreds of people looking for them. You can get rid of that and save us, 8 months of this stupid excise duty. And why does the government own L&T? We do not want the government owning L&T. We should get rid of that shares immediately. I'm not even talking about privatizing public companies. I am saying sell shares of private companies that you already own. I'm sorry, the thing is moving because I'm also excited about this. So Just, government could do that. Recapitalizing banks through the deficit is a bad idea. I think what they should be doing is looking at banks themselves and selling ITC, selling, sorry, not ITC, I meant selling the government held stake, which is, I think there's a number of land holdings like SBI has, which it holds at cost. So it might hold a prime land in Bombay at say 1 crore when its market value may be 400 crores. Find a way to get rid of that land. Why does SBI need a 1 crore to, I mean, a colony worth 400 crores just to house its people? If you rented houses, take the 400 crores, take the interest, rented houses, I'm sure you could easily house those 400 people or 500 people that live there and still make a profit. And may add substantial amounts to your bottom line. So I think that's a good thing. No, I ordered from Gusto's Pizza. I don't know who they are, but they great pizzas, and I got a 50% discount. They're not even an online startup. So, if you order from an online startup, you get to pay the full price minus whatever discounts the online startup gives you. These guys give you a 50% off straight away, which is my value buy for the day. That's all. That sounds like value, and that's all that you can buy on a Saturday anyway. So, yeah, so a pitch on Capital Mind. Subscription. What does option analysis do? We do a lot of derivative analysis on the options markets and the futures market. A lot of it is discussion that comes through our Slack channels that gets processed into videos. We've done a lot of stuff on covered calls. We've done something on how you can actually build a strategy that gives you no downside but gives you an upside that's very close or similar to the Nifty. We did this about 2 years ago. We've done things like indexes and data analysis on options itself that gives you things. We have our own strategy called MA20, and wait, I'm going to be going too much on a pitch. Go to capitalmind.in/subscribe. You'll find a lot of details in there, but we have a lot of stuff that we do on options. We've got a new strat options based strategy that where we are trying to target a very useful interest rate per month that we can get on investments. I'm not going to say what numbers and all that stuff, but we are trying to use strategies, quantitative analysis, rather than just technical analysis. How does it feel to be a startup owner? I don't know anything else, man. I'm not qualified for most jobs because I have been a startup owner since 1998. This is my 4th startup. Hopefully, I mean, my house is nice, but I wish I could say that I was that massively successful Sabir Bhatia or one of those really rich startup guys, but I'm not. So, but maybe then I wouldn't be doing stuff like this. I'd probably be sitting very quietly and investing my money without talking to anybody. I don't know how boring that is actually. This is more fun, but at least I'll probably travel a lot more. But yeah, so how bad is it in new downturn in new tech investments? It's a function of liquidity. One of the problems you have in the world markets is the lack of liquidity. It is going to die, in my opinion. In a lot of ways, liquidity is going to reduce, and that is going to hurt everything, including startup investments. Much of startup investment zone has been made, I mean, not directly, but indirectly, because you didn't get high yields anywhere else. The minute you start having to compete with an 8% yield per year, then giving money to somebody for 10% return or a 20% return after 10 years is not going to sound very exciting. At 8% in 9 years, you better double your money. That's just the cost of it. So if I'm going to raise $100 million fund, I am going to have to see at least $200 million by the time the fund ends. And by the way, since I'm taking 2% a year as a management fee for a startup fund, that's 20% gone. So I have to invest 80% of the money, $80 million, to get 200 million out. So that's a 250% return I really have to work with before before my customers think that is a good deal. I don't know when that's going to happen, maybe, or that's going to take 5 or 10 years to happen, but I think that's the way that people are going to suffer in this case. Okay guys, it's 9:30. It was a long chat. I didn't think it would be so long. I hope you liked it. This is no screenshots, no nothing, but I hope you enjoyed it, loved doing this. I'm going to try and post it somewhere online so you can see the recording as well. Have fun, have a good Saturday night. I'm going to enjoy some pizza. 50% discount pizza, value buy for the day. Take